Welcome, everyone, and thank you for joining us. This is going to be Anchor's 10th session of our Prep Your Firm webinar series. If this is your first time joining us, this series is all about giving your firm a stronger start to 2026. Today's session will be recorded, and we'll post the full recording on YouTube afterwards, so you can revisit it or share it with your team. As always, feel free to drop questions in the chat as well. We'll save some time at the end for a Q&A so we can tackle as many questions as possible. With that, I'm pleased to introduce today's speakers, Dr. Bardia Hariri, Principal at Hariri Financial Partners, and his partner, Zeus Kajita, who runs business development at Hariri Partners and AIP. So without further ado, Dr. Hariri, the stage is yours. Thank you.
Thank you. Thank you so much. Very good morning and good afternoon to our friends in the East Coast. My name is Bardia Hariri. You can just call me Bardia. My background is economics. I was a university professor back in the UK. And then I came here for the American Dream about 13 years ago. And yes, American Dream is alive and well, but it's not handed over to us. We have to create it for our community and protect it for our community, our family, and ourselves. Speaking of protection, what we do is asset protection, tax reduction, and overall estate plan. Because at the end of the day, it's really not about what we have. It's about how much we put into our pocket. A little bit about our firm. We started about 12, 13 years ago. Today, we have a little bit over 2,500 clients. We have presence in 13 states. We have an office in our California office. We have an office in Roseville, San Francisco, and SoCal, Irvine. Representing about 2,500 through our collective effort of 138 advisors in 13 different states. So we are fortunate and we are as grateful as we can for the resources that we have. So going back in today's session, we want to focus mainly on how to integrate some of the unique strategic tools by integrating them into the existing practice of accountants and tax attorneys to help them look like a hero in front of their clients. Income tax, capital gain tax, and estate tax. These are the key areas that we want to focus on. You may come across somebody who wants to sell a $50 million hotel, but then next thing you realize in California, they have to pay about $19 million in taxes. The question here is, how can we mitigate that? Or right now, stock is all-time high. People are worried about the stock market. People are worried about the tariff and the trade war and what is happening in the world and the uncertainties and the issues with Russia and Ukraine and then the Middle East crisis. So people are worried. Should they sell? Should they sell their stocks? If they sell, they have to pay capital gain taxes. How can we de-risk our stocks and mitigate that capital gain tax? That's the area that we want to also discuss. And the other area is, estate taxes. Especially in the Bay Area, you will see a lot of startup owners that their business is valued $50, $70 million, but it's really paper money. It's not the real money. It's not actually $70 million sitting in bank. The business valuation is $70 million. But then tomorrow they die, what would happen? The government is asking for $16 million estate tax just because the business was valued at $70 million. How can we mitigate that estate tax? How can we avoid fire selling the estate to take care of the government and at the same time preserve our assets for our kids? So these are the areas we want to talk about. Is not the usual tax filing conversation, is mainly those strategic tools that we have to integrate into our existing practice in order to be able to maximize the tax saving while we are de-risking our clients' portfolio. So let's first start with income tax, right? Some of us would think that we are paying a lot of taxes, but I'm sure that many of you would agree that historically we are at the lowest tax bracket. Just let that sink. Just literally go on Google and search US tax history and just click on image and take a look at the graph. Back in the Second World War, the highest tax bracket was 90%. Later on in the 50s and 60s, it became like 50, 60%. Right now it's what? It's 47%. And we all know how much debt we have. Just open up another tab and you just search US tax History, open up another tab, just type US national debt. Look at that huge debt. We have to pay more taxes to tackle that debt. Otherwise, we go on default. So, are we going to be at the lower tax bracket? Most likely, no. So, we have to talk about it. How can we mitigate it? How can we reduce our taxes today and also create tax efficient sources of income for future? Because most likely, we are not going to pay less taxes in future. But what's the solution? Business owners have some sort of solutions. People who are with W2, they have limited solutions. Many of you in this call are accounting professionals, CPAs. You understand that when you have W2, probably 401k, probably mortgage interest, probably that's pretty much what you can do. But there are some strategies that you can also explore that we are going to discuss here. How can we leverage our real estate holdings? How can we create an entity, etc. But let's start with the simple part. You are a business owner, 2025 tax year. You already made seven-figure income. You have to pay $300,000 in taxes. Can we defer our taxes? The answer is yes. And that is called deferred compensation. Take a look at this table. Just for 2024, I would be able to also email you 2025 separately. Pretty much is almost the same numbers indexed with inflation. Technically, each business owner can defer up to almost $380,000 a year using their defined benefit pension plan. But of course, there are pros and cons about defined benefit pension plan. If you are running a solo business with no employee, yes, you can pretty much max that based on your W2 and based on your liquidity needs. And every dollar that you put saves you about 47 cents. Plus, that dollar grows in the market at 7 to 10% a year in average. So, in terms of rates of return, it's great, especially if you start taking the distribution up in retirement in different states or at the lower tax brackets, right? Mathematically, it makes sense. But that's not always the case. Many people have a lot of employees and then they say, okay, I would love to set up this cash balance defined benefit plan that I see on this table, or I would love to set up this 412(b)(3) plan that I see here. But when the third party administrator runs the number, they figure out, ouch, in order to be able to put $380,000 or $400,000 in your defined benefit plan, you have to invest another $200,000 for your staff. Otherwise, you are discriminating. Then what's the solution? That's where we have to explore and figure out, okay, can we create another business entity? Can we have that business entity as a complement to the company A, like a new vendor, like an R&D firm, research and development firm, like marketing and lead generation firm? Can we have that company B that is a complement to company A? And if the answer is yes, then okay, that's one check mark. The second question is, are we running this with our spouse? Are we in a common property? Yes, no. Do we have non-related family members? Yes, no, that they can be part of the company B, because we should not own company B more than 80%, because we have to dilute the shares to avoid the control issue. So those are the conversations that we should have to figure out, okay, can we create company B in order to complement company A to be able to use these numbers that you see on the table and defer the taxes while you are not discriminating and you're still taking care of your other employees using just normal 401k plan, but using defined benefit for your company B, for yourself and for your spouse. So the key here is control group issue and complementarity relationship of company A and company B. And that's where we need to have more in-depth conversation with the client to figure out what model makes more sense, whether it's employing their adult kid and their spouse, or whether it's employing their spouse and a non-related family member, as long as the spouse of a common property is not owning more than 80% of the company B. So these are the nitty-gritty portions that you, as a CPA or as an accountant or as an enrolled agent or a financial advisor, you must always have the conversation with an expert, with a third-party administrator, to make sure you are in compliance with ERISA and IRS. Now, we are setting up this defined benefit plan for somebody who is having at least $100,000 a year tax liability. But what if we're talking about a smaller firm? What if you're talking about a mom and pop shop? What if you're talking about a hairstylist that is just making maybe $80,000 a year? Can we still do that? Well, it depends. Should we or should we not? If you're talking about somebody who is making $80,000 a year, most likely when they retire, probably they're going to retire at the lower tax bracket. So the question here is, do we want to just defer all the taxes now and later on pay all the taxes? Or do we want to pay the taxes now, bite the bullet, and grow the assets tax free? So again, that's again a conversation that you have to use Monte Carlo simulation and different fact finding questions to be able to figure out, okay, is the client going to retire at a higher tax bracket or lower tax bracket? Because believe it or not, sometimes it might make sense, depending on their age and their income level, to bite the bullet, pay taxes now, and invest in the Roth IRA or Roth 401ks. Because then you're paying taxes at the seed, but then you don't pay any taxes at the harvest. Right? But then let's say, no, actually, they are at the higher tax bracket and they are going to retire at the lower tax bracket, but they are not really making a lot of money. Then, of course, cash balance plan or 401k are actually overkill. At that time, we talk about maybe simple IRA, maybe SEP IRA, maybe just a 401k, maybe just a profit sharing plan. So all of these mechanisms that you see on this table are options. Just like when you go to a pharmacy, you have a lot of pills. None of them are good or bad. It's all about the right patient. That's why we need to ask our clients to figure out, okay, how much money they're making, what is their liquidity need, what's their risk tolerance, what tax bracket they are, and then what are their other financial goals, so that we can figure out where they will end up in the next few years in terms of tax bracket, and then frequently meet with them to be able to recommend them the right solution. We have to also be very conscious of the fees. If we are talking about one store, or let's say a CPA firm or a law firm or maybe an accounting firm that has one employee, or maybe a realtor who has only one employee, maybe 401k is just an overkill. Why do we have to pay $1,500 or $2,500 a year on the third-party administrator? Why don't we just set up a SEP IRA? Why don't we just set up a simple IRA so that we don't pay that TPA fee, third-party administrator fee? But again, it has its own pros and cons. With a 401k, you can borrow against the money if you want it before 59 and a half. With SEP and simple, you can't. So as you can see, everything has its own pros and cons, right? And a good financial advisor is an advisor that is asking the right questions to figure out what's the purpose of that money, what is the risk tolerance, what's the liquidity need, what's the investment horizon, and then recommend the right solution, which is not only at the lower cost, but also minimizes the taxes today and minimizes the taxes tomorrow. So there is no size fits all solution when it comes to financial services. But this table pretty much defines what are the tax deferral options out there, right? If somebody has to defer taxes. But then you may come across somebody who is actually a professional in the real estate industry, or maybe they have a full-time job, but their spouse can be justified as a full-time real estate professional. How? By just showing that, hey, I've been working 750 hours a year on managing my real estate, literally 2-3 hours a day, chasing the contractors, calling the plumber, chasing the Airbnb guys, right? So if you can prove that you are working 750 hours a year on your real estate, then we have more opportunities. It's called cost segregation. What is cost segregation? We all know about the depreciation of the properties, right? But the problem here is many of us, we just take our time and depreciate that property over the next 20, 30, 40 years, right? But if you can prove that either you or your spouse are full-time real estate professionals, let's say you're working 750 hours a year, if you get audited by the IRS, if you can prove that you're working 750 hours a year on the real estate management, then we can actually squish the depreciation. Instead of waiting for 30 or 40 years, we can squish the depreciation to 10 years or 5 years or 2 years or 1 year. What does that mean? It means you can accelerate the depreciation. For instance, let's say you have $1 million condo. You bought it, let's say in 2018. For that $1 million condo, most likely you can squish the depreciation for about $250,000 if you want to accelerate it all into 1 year. And if you're at the highest tax bracket, it means in 1 year you would be able to save about $150,000 to $160,000 in taxes. That cost segregation is life changer, right? For many of those people that they can prove that they are full-time real estate professionals is a life changer. As long as if they get audited, either themselves or their spouse, they can prove by showing their calendar, by showing their to-do list, their invoices, etc., that, hey, I worked 750 hours on managing these properties. Cost segregation is not something that you just do it by yourself. You can't use ChatGPT. No, you have to actually hire an expert firm. We do offer those services as well, by the way. But in an expert firm, you have a CPA and you have an engineer. It's not just a CPA job. It's not just an engineer job. It's a CPA and the engineer job. You have to actually go to the property. These days, everything can be done remotely. The engineer is behind the line, is asking you to take a picture of all the places of the property, and then they will put together a report within 2 to 3 weeks. Most likely, the cost is between $3,000 to $3,500 per unit. Back in the day, it used to be 20 to 30 grand, but now it's much, much cheaper thanks to technology. So now you think about it. You have a $1 million condo. Your spouse can justify that she or he is a full-time real estate professional. You spend 3 weeks conducting the cost segregation study. You pay about $3,300, $3,500. And then by the end of the year, you save about $150,000, $160,000 in taxes. Now, add that into the other portion, the other table that I showed you. You can dump $400,000 into your defined benefit plan. Every dollar gives you 47 cents in tax deduction. That dollar grows at 7 to 10% every year, doubles your money every 7 to 10 years. Pretty much you're getting over 50% rate of return on your dollar. That will help you to save almost 7-figure in taxes. So things like that are important to start the conversation with your financial professional, right? And this is the time, because if you want to set up that defined benefit plan, and if you have to create that company B because you have too many staff and you cannot use your company A to do that, you have to create that company B before the year end. So right now it's November 18. It has to be done within the next month or so, because next year is next year. It's too late to create that entity, right? But for cost segregation, you can do that anytime before you file 2025. Anytime before you file taxes for 2025, you can still do the cost segregation as long as you purchase the property in 2024 or before, or sorry, in 2025 or before. So even if we are in March 2026 and you want to conduct the cost segregation on the property that you purchased in 2025 or before, you are okay. So don't worry about the cost segregation. But if you want to set up that defined benefit plan, but you have a lot of employees and you have to create the entity, you have to do it now. But if you don't have to create a new entity, you have time to max your profit sharing. You have time to set up your SEP IRA or simple IRA even a day before you file your 2025 taxes, right? Many business owners actually they file extension. Many people, they actually set up their 401k, their defined benefit plan, their profit sharing, their SEP IRA or the simple IRA, even sometime in July, August, or September. And still, every dollar that they put in 2026, they can write it off against 2025, right? So these are all the nitty-gritty tricks that are beyond the theoretical things that we study in school. But when it comes to practice, we learn all of these things. Nobody has taught us this, right? So that's why it's very important to talk to a financial professional who's been in the firm for at least 10 plus years so that they have seen it all to be able to tell you what can go wrong, etc. But bottom line, when it comes to income tax mitigation, whether you are a W-2 or whether you're a 1099 employee of a firm or your own firm, always think about whether it makes sense to pay taxes now and grow it tax-free or not. If you think that no, you still need to reduce your taxes, then we have to look into deferred compensation, up to $400,000 a year. And if not, then we have to bite the bullet and pay taxes and grow the wealth tax-free. Every dollar that you put into the market grows every 7 to 10 years, whether it's real estate, whether it's a stock market. On average, it doubles every 7 to 10 years, growing about 8 to 10% a year, right? Now, if that goes into a pre-tax, that's additional 47% tax deduction. If it's post-tax, you don't have that. So it's a pure mathematical decision. There are many softwares out there that you can simulate to figure out, okay, how much should I put pre-tax? How much should I put post-tax? How many years should I conduct cost segregation? For how many years? What are the pros? What are the cons? These are things that you need to have a one-to-one conversation with a financial professional. And that's what we do for a living, to be able to figure out how much and where to. Now, of course, taxes is not all about the entire of our goals. You must have many other goals in your life. You have a kid to send to college, you have a house to buy, you have a rental property to purchase, you have debts to take care of. So that's why a holistic picture is very important. At the end of the day, money is a tool, and we have to understand what's the purpose of the money. And then based on that, we figure out, okay, how much of that is going to help you with the income diversification, how much of it is going to help you with the tax diversification, how much of it is going to help you with your asset protection. So don't just simply say, okay, I want to open up a Roth because ChatGPT said. Don't just say that I want to open up a defined benefit plan because my colleague did that. Don't just say that I want to do cost segregation because my neighbor is doing that. No, I'm not going to take medicine because my cousin told me. No, I will take it because my doctor has done the assessment. And then based on my situation, I will take that prescription. Same thing here. Thorough conversation is needed before you make a decision of which tools to be leveraged for your tax saving strategies or for your clients' tax saving strategies. So we covered the income tax reduction. Let's just look into the capital gain tax reduction. Capital gain tax reduction, think about it. Market is all-time high. Many people are very worried about the market. They want to de-risk their portfolio because many people say that, hey, by January, market goes down because historically most of the recessions happen in January because it's after a holiday, because there hasn't been so much of an earning report on Q1, because now there is a crisis happening in the Middle East. There is a war. There might be a war happening there. There might be another concern between Russia and Ukraine. There might be some other disputed issues in China and the Japanese continent. So all of those issues makes people worried, especially those who are in the tech. They say, oh my God, my stock is all-time high. Should I still be greedy or should I exit? I don't know. It depends on your risk tolerance. It depends on your liquidity needs. If you need your money in the next 3 years, if you want to retire in the next 3 years, you should not be probably fully in the market anyway. So that's, again, a conversation about the purpose of the money and your risk tolerance and your liquidity need. But if somebody says, I want to retire in February 2026 and I have $3 million in my Google stock, then yes, we have to probably de-risk that. We have to lock the gains. And by doing that, we have to pay a lot of capital gain taxes. But how can we avoid that? So something we want to talk about is called Charitable Remainder Trust. Charitable Remainder Trust is actually not giving money to charity. Charitable Remainder Trust is creating a trust that can help you maximize your tax deductions while creating a guaranteed lifetime income for yourself, right? So in this example, if somebody has $6 million stock, this is an actual example of a 62-year-old who had a $6 million Apple stock, and he was referred by his CPA. So technically, with his cost basis of $500,000, he had to pay a substantial amount of taxes, right? I mean, this gentleman, I think, yeah, this gentleman had to pay $2 million in capital gain taxes. He was freaked out. He wanted to exit. And he wanted to retire, but he didn't want to pay that $2 million in capital gain tax. So easy solution for him was to create that charitable remainder trust. Creating the trust takes about 3 days. It costs about $3,500. You transfer the stocks into the charitable remainder trust. Immediately, it gives him $1.3 million charitable deduction, and it will give him 7% guaranteed lifetime income. And that money is growing in the trust for the benefit of a charity, so that upon his demise, the money goes into that charity. So I repeat, there was a $6 million Google stock. He had to pay $2 million in taxes, but he de-risked that by transferring that $6 million into the charitable remainder trust, which only cost him about $3,500 to create that trust. By doing that, he created about $1,000 a year lifetime income plus $1.3 million charitable deduction, which he's going to take that deduction over the next 10 years. He can take all of that deduction on year one as well, but there is a reason that he's doing that, because he also has another $5 million in his 401k. So he wants to do some Roth conversion for the next 10 years. So we are actually using this charitable deduction of $1.3 million to not only offset this $420,000 a year lifetime income that he has, but also offset his Roth conversion tax liability, so that over the next 10 years, he will convert fully that $5 million 401k into $5 million Roth, and he will de-risk his Apple stock and generate lifetime guaranteed $420 a year. By this way, he is not only de-risking his Google stock, but also he's converting a highly taxable legacy to a tax-free legacy and a tax-free source of income for himself, right? It takes time. It takes about 10 years to do that, right? But at the end of the day, what's the alternative? The alternative for him is most likely by January and February next year, his stock could have been cut in 20%, 30%, half, because of the volatilities. And if he dies, his $5 million 401k, almost half of it goes to the government, because his kids have only 10 years to satisfy the RMDs, required minimum distribution. But by doing so, not only is going to get $420,000 a year lifetime income, but also he's going to have $5 million tax-free in his 401k Roth, in his Roth over the next 10 years. Now, you may wonder, okay, what's the word charity here? Well, if he dies, whatever that he put into that CRT, into that charitable remainder trust, goes to the charity of his choice. But there are two solutions here. Many people, especially first generation immigrants who started from scratch, they may say, yeah, I like all of these, but I earned this money. I suffered. I didn't have this money. Nobody gave it to me. Why should I give it to charity? Is a very fair argument. There are two solutions for that. One, you can get yourself a term insurance for the next 15 years, so that if you die, that $6 million that you put into the charity will be replaced by the term insurance tax-free. Or you can actually have a family foundation, so that if you die, that remaining of the $6 million goes to a family foundation, and then you can put your kids on the payroll of a family foundation. Now you know why most of the politicians and Hollywood people, they have a family foundation. It's not necessarily because they are very good people. It's because of taxes. So I'm not too sure if we have, feel free to drop your questions. I will also read questions, and we will have question and answer session, but make sure that you don't forget your questions. Drop the questions. So far we talked about what? So far we talked about how can we defer your income taxes. You can put as much as $400,000 a year using the defined benefit plan. It's very important to figure out whether you need to create another company or not before the year ends. We also talked about how to de-risk your portfolio, especially now the market is all-time high. How can we mitigate the capital gain taxes while you're de-risking your portfolio using charitable remainder trusts? And not maybe just de-risking it, maybe just exiting the business. I had a client who wanted to sell his hotel. He had the Hyatt Hotel in Sacramento, first-generation immigrant, and his kids were all in medical schools, and they were totally out of the business. They were just plastic surgeons and dentists. They didn't want to manage a hotel. And the gentleman, he wanted to exit his hotel, but he didn't want to pay a lot of taxes. When we ran the numbers, he said, yes, I will sell this $50 million hotel because kids don't like it and I'm tired. I don't want to manage it, but I have to pay almost $19 million in taxes. He's selling his hotel for $50 million and he has to pay 19 in taxes. But just because of this charitable remainder trust, he dropped that $19 million to $12 million and pays that $12 million over the next 15 years. And he's actually getting $3.5 million a year lifetime pension for the rest of his life. And if he dies, the remaining of it goes to a family foundation, so that we will have his wife and later on his kids on a payroll of a family foundation. So not only he saved $7 million in taxes and generated $3.5 million lifetime income, but also if he dies, he's going to get the same money back tax-free outside of his taxable estate, because he also had estate tax liability, which brings us to the conversation about estate tax, not state, estate with E. Right now, each of us, we have about $13 million. Next year is going to be $15 million lifetime exception that we can leave to our next generation when we die. Anything over that is subject to 40% estate taxes. What does that mean? It means if you have a net worth of, let's say, $70 million as a husband and wife, regardless of the state of residence, as long as you're American, your estate tax is about $16 million. I repeat, if your net worth is $70 million, or if you have a client who has a net worth of $70 million, 70, by the time that the husband and wife die, the kids have few months to pay $16 million in estate taxes. $16 million. And think about it, when somebody has a $70 million net worth, they don't necessarily have cash in bank or stocks. That $70 million, most of it is a business valuation, which is not the liquid money. And the remaining of it is tied into real estate. So kids have to come up with $16 million immediately within the next few months. They have to fire sell the business. They have to fire sell the building, or they have to get those massive cash out refi loans against the property and the business of their parents in this extremely high interest rate environment. That's terrible. Now imagine if the market also goes down. Let's say the client dies in January 2020, suddenly March 2020 recession happened, everything is half a price, kids still have to fire sell the property because the estate taxes was determined and calculated based on the day that the second person died, right? The estate tax triggers when the second spouse dies. So if the second spouse died in January 2020, right before the pandemic, and then during the pandemic market tanked, kids had to fire sell everything to pay the government. But what is the solution? What is the solution? How can we avoid, or how can we create that liquidity to pay the estate taxes? The solution is easy. In this example of having a $70 million net worth with $16 million estate tax liability, solution is having a $16 million life insurance outside of the taxable estate inside the Irrevocable Life Insurance Trust. Nice. $16 million kicks in tax-free. I use that to pay the government. I keep my business. I keep the real estate. I don't have to fire sell anything. Sounds good to be true. How much is $16 million permanent life insurance? Well, it's quite expensive. It's about $800,000 a year over the next 10 years. What? $8 million commitment over 10 years to pay a $16 million life insurance? I'm not going to do that for my kids. That's a typical answer you hear from business owners. But there's a solution. What if I tell you that you can have that $16 million life insurance, kicking it outside of the taxable estate for your kids to pay the government and preserve your assets without you even spending a single dollar? I repeat. What if I tell you that there is a solution that you can have a permanent $16 million life insurance to preserve your estate without spending a single dollar? I repeat for the third time. What if I tell you that there is a solution that you can have a $16 million life insurance without paying a single dollar? Sounds good to be true. What's the catch? It's called VRDO, Variable Rate Demand Obligation. Here, Variable Rate Demand Obligation Note. We are actually partnered up with Goldman Sachs. Funny enough, there are only 4 other firms in the US that are partnered up with Goldman Sachs. It's the game of arbitrage and leverage. You borrow from Goldman Sachs at 5%, pay the premium of your Irrevocable Life Insurance Trust, which is following the pace of the S&P 500, which is 7, 8, 9, 10%. So you have positive arbitrage, right? Over the next 10, 15 years, there's enough cash value inside the policy that you can borrow from the policy, pay back the VRDO note. So you borrow at 5%, grow it with positive arbitrage. After 15 years, you pay back the note. How much do you have to pay? Nothing. What's the catch? Collateral assignment. So you have to collateralize an asset so that you can get those VRDO bonds from Goldman Sachs or from Wells Fargo or from BBVA, right? For every $1 million that you collateralize, they give you about 5 to 6x leverage. So if you collateralize $1 million condo, if you collateralize $1 million treasury, cash, stock, business valuation, an asset in China, an asset in India, an asset in Philippines, as long as their banks are in compliance with OFAC, you can get a control agreement for every $1 million. You can get a control agreement and get 6x leverage to fund an irrevocable life insurance trust. That policy grows with a positive arbitrage. In about 15 years, there is enough cash value that you can borrow against the policy, pay back the notes, pay back the life insurance, release your collateral. Especially this is very popular among the foreign nationals, because foreign nationals, people from China, people from Israel, people from India, they have good money. They come and buy beautiful mansions in the US, but then they don't have the citizenship because they're back home. They're going back and forth. Their kids are settled here in the US. Suddenly they die. The kids have to pay a huge amount of estate taxes. And remember, estate taxes for foreign nationals is not $13 million exception. It's about $100,000. So foreign nationals, they have significantly higher estate tax exposure. And for people who are coming from China, they have another problem. Because of the Chinese regulation, they can no longer bring cash here to pay those large life insurances or to bring cash here to pay the estate taxes. So imagine father with a successful business in China came here, Beverly Hills and Atherton, couple of beautiful multi-million-dollar houses, and we are talking about millions of dollars estate taxes. But then the kids or the father, they cannot bring money from China because of the government regulation. They cannot pay for the estate taxes. So what's the solution? The solution is going back to their bank in China, get a control agreement, get a letter of credit against their assets, coming back here, going to Goldman Sachs, borrowing at 5%, putting it into their irrevocable life insurance trust, which is growing at 7, 8, 9, 10%, positive arbitrage, almost 6x leverage. There's no single dollar moved from that country. It was just a control agreement, letter of credit against an asset or a business or cash in their bank. And in about 15 years' time, release that collateral, pay back the VRDO just using the positive arbitrage of your ILETs. Simple as that. And then parents die, kicks in tax-free life insurance outside of the taxable estate in the irrevocable life insurance trust. Now, it's brilliant. Sometimes looking into these strategies, you may wonder, oh my God, life is not fair. Where rich people are getting richer because capitalism is designed for people with capital. The more money you have, the less tax liability you have, more privileges you have with financial institutions. And that's a reality. And that's a good reality. You cannot beat it. So be with them, right? So pretty much the table that you're looking at right now is one of the examples of one of our clients who did actually gap collateral of about $3 million in order to get almost a $30 million policy. The last column is the death benefit. In this case, this gentleman actually used this policy to create a lifetime pension for himself. This gentleman is just collateralizing $3 million municipal bond, which is not growing more than 2 to 3% a year. But by just being patient for about 11 years, he's creating almost $500,000 a year lifetime income, tax-free income for himself. He's not using this life insurance as a estate tax mitigation strategy. He's using this life insurance to create a tax-free pension for himself. Think about it. All he's doing is just leveraging a municipal bond, which is not really growing much, but he wants to keep it because that's his father's gift, right? So he's just using that to create $500,000 a year guaranteed tax-free pension. Why is tax-free? Because he's borrowing against his life insurance, and life insurance is tax-free. In this country, only Roth and municipal bond and life insurance are tax-free. Other assets are all taxable unless you do those cost segregation studies that I explained earlier to be able to mitigate your income taxes. So still is not tax-free. But life insurance is tax-free. This guy is generating, in average, 7 to 10% a year in this policy, all tax-free. Otherwise, he had to generate 14% a year in his tax bracket to be able to have equivalent of 7% a year tax-free, right? So I pause here. There's a lot more stories that I can share with you. I just want to conclude before we go into the question and answer by saying that it's really not about how much money you have. It's about how much you get to put into your pocket. We just explained a scenario of a business owner whose net worth is $70 million. And if he dies, his kids have to pay $16 million if they don't do any plan. But there is a solution for it. We just explained the scenario of somebody who is selling a $50 million hotel and he had to pay $19 million in taxes, but there is a strategy that dropped that $19 million to $12 million over the next 15 years while it's giving him $3.5 million a year lifetime pension. So the choice was his, either paying that $19 million or just waiting for 15 years and using the gains of his money to be able to pay that taxes. So nothing out of his pocket. Or we just gave an example of somebody who's making 7-figure income, but instead of paying $400 a year in taxes, he's actually building a very nice pension for himself and not paying taxes for it. So these are all nice examples. There are a lot of success stories that we can share, but at the end of the day, money is a tool. We have to understand the goal, pain, concern, what keeps the clients up at night, and the purpose of the money, what else they have, what is the risk tolerance, what's the liquidity need, what's the time horizon. And based on that, we run simulations and understand how to protect what they have today and moving forward, how much and where to allocate their assets. So I pause here. I would love to hear from you. My colleague Zeus is also here. We are here to, answer any questions that you have. Hopefully, we can also be in touch after this session. You can have my contact details. Reach out to Zeus, reach out to me. We can offer a complimentary consultation to discuss more, and hopefully we can be a resource for your clients. Zeus, any observation?
Let me see what this says. How should accountants frame CRTs, life insurance trusts, and other concepts with clients? Is the approach within annual tax planning or via a separate estate tax strategy session?
Thank you. That's a very good question. First of all, go back to your book of business and figure out who are the clients that they paid at least minimum $50,000 in 2024 tax year. Minimum $50,000. Those business owners who paid minimum $50,000, that's a great opportunity to reach out to them and say, hey, when was the last time somebody reviewed your tax saving strategies? Will you be open to talk to a financial professional? Then we have to do together with your clients some fact finding to understand what they have done. Are they qualified for tax deferral strategy? Are they qualified for cost segregation, right? So for those who paid minimum 50 grand in income taxes, that's a perfect opportunity to go back to them and ask, when was the last time somebody reviewed this? For those clients who are about selling highly appreciated assets, whether it's a building, whether it's a business, whether it's a stock, before they sell, I repeat, before they sell, you need to educate them about CRT. Once they sell, it's too late. We cannot do anything. If they are selling a property, let's say they are selling a property, they do not want to do 1031 because they're sick of tenants. They do not want to do opportunity zone because they do not like those cities. They do not want to do any Delaware statutory trust because they want to have control over their money. What's the alternative? Either bite the bullet and pay taxes or create a CRT. If they need income and they want to mitigate capital gain taxes, they have to do CRT. But it has to be way before the money goes to escrow. So the moment that the client is thinking of selling their property, the moment that they're thinking of selling their stock, you should have that conversation with them. If they already sold and the money is sitting in the cash settlement or in the escrow, it's too late. So maybe going back to those clients that are thinking of selling the commercial building and exit the industry. Maybe going back to those clients that are worried about the stock market and they want to de-risk their portfolio. Just educate them about the CRT and then meet with us, meet with the financial professional to understand whether it's a suitable strategy for them or not. Again, before they sell. And then for the third one, which is estate tax, anybody who is expected to be over $30 million as a married couple, over $30 million, or anybody who is expected to be over $15 million as a single person, including their business valuation. That's a perfect qualifier. Just ask them, hey, when was the last time that somebody reviewed your estate tax plan, right? When was the last time somebody reviewed your estate plan or your estate tax liability? Have you sat with somebody to run a simulation to figure out how much you have to pay if you die today, how much you have to pay if you die in 20 years? Just ask them, when was the last time somebody had that conversation? And then you can start bringing the topic.
Thank you. This has been super informative. Dr. Hariri, I don't know, you did cover it, I think, throughout all three of these strategies, but are there quick eligibility requirements that would apply to folks who are trying to go for any of these three strategies that people should keep in mind?
I think, yeah, as briefly mentioned before, if business owner clients are expecting to pay more than 50 grand a year in ordinary income tax, that's the first starting point to figure out how can we maximize the tax saving strategy for 2025 tax year, whether it's buying more equipment, whether it's buying a car, which is over 6,000 pounds, whether it's setting up these deferred compensation plans, which you can put up to 400,000 a year, whether it's your spouse qualified to become a full-time real estate professional and leveraging some of the cost segregation strategies. So minimum 50 grand a year, that's a qualifier for income tax. And then people who are worried about the stock market, they want to de-risk, but they're hesitant. I literally ask my clients, if there was no taxable liability, how much of your Google stock would have sold today? They mainly say 70% or more. That's the level of trust that we have. People are freaked out about the stock market. I don't know. Nobody has a crystal ball. Maybe market will continue growing. Nobody knows. But when I look into the price to earning ratio of these stocks, and when I look into the global, and when I look into the paralyzed country that we have, which once was a great American dream economy, and now is so two mentalities, all of these are worry. Plus, we have the AI bubble, which may or may not be real, right? Three companies are just giving each other trillions of dollars, right? And it's not adding anything into the economy. So all of these are concerning. People who are concerned about the stock market, ask them, hey, if there was no taxable liability, how much of that would you wanted to sell? Then figure out, okay, if they wanted to sell at least $1 million, then that's a perfect case study for a CRT. And then you can educate them how CRT works. We can have a conversation together. And the last one is people who have at least $15 million net worth, including business valuation. And if they have kids and they want to preserve their business and their estate against estate taxes, just ask them, hey, when was the last time somebody reviewed your estate tax liability?
Got it. Super helpful. Thank you again, both of you, so much for all of this great information. As I mentioned, this will be available on YouTube, this recording, along with all of our other Prep Your Firm sessions. You can find our channel. It's at youtube.com/@sayanchor, and I will put that in the chat. And, stay tuned for our upcoming sessions. We're going to take a break next week for Thanksgiving, but we'll be back in early December with a few more to round out the year. And again, thank you to both of our speakers today. Zeus, Vardia, thank you so much. This has been great. And appreciate everyone who joined. So thanks again, and take care, everyone.
Thank you for having us.
Thank you so much. Grateful. Thank you.
We'll be in touch.